Let's talk about the best tax benefit in America, okay, bar none.
I'm
And that
ready.
is,
I'm ready, buddy.
yeah, okay, here it is. It's depreciation,
Yeah.
okay? Why is depreciation so great? Because it's a non-cash write-off. It's a phantom write-off.
I do a lot of live streams and I'll get 500, 600 people on there. And
Mhm.
man, like 20% of the questions that I get is, George, I know that you love rental properties, but how can I invest in rental properties if I have a 401k and an IRA? And I keep telling people, I need to do that homework because I've never had an IRA or a 401k. So I thought this would be an amazing
Yeah.
opportunity because you know so much about it. You're the pro
Mhm.
to really kind of take a deep dive on that, so
Yeah.
everyone can understand that a lot better.
Okay, so first of all, a deep dive on this subject would take a long time. So this is not a deep dive, okay? But I'll give you the basics. It's really not that complicated, okay? I mean,
Great.
of course, it can be complicated if you want to do creative things. But here's the basics. It's really quite simple. What you need to do is you need to set up a self-directed IRA, or if you have a business and you have a solo K or a solo 401k, it's called, or a solo K. I have that and I have an IRA. I have both types of accounts myself, okay? Because I have my own business, right? With those, you can make those accounts self-directed. Normally, they're not. Normally, you just went to some brokerage and went to Fidelity and said, I want to open up an IRA account, and they showed you some stocks or some mutual funds to buy in your account. That's
Right.
not self-directed, okay? You need to go get an IRA custodian, right? And there are a bunch of them out there. We can recommend some if any of your people want to go to jasonhartman.com, reach out to one of our investment counselors. We'll be happy to provide a list of referrals of companies that do self-directed accounts of 401ks or IRAs, okay? And basically, once it is self-directed, you're now in control of directing what type of investments you want to do.
Mm.
And you can loan money, you can be a hard money lender, you can buy properties, you can invest in other things too, okay? But there are rules about it. They have to be arm's length, they call it. And you have to treat your retirement account as a separate entity, okay? And you can take distributions when you're 59 and a half, but you'll be forced to when you're 70, okay? So you're going to have to take money out and pay taxes eventually. But the beauty of it is you can invest that money through that account that's like this separate vehicle that does have some nice asset protection features as well if you ever get sued or have a creditor problem. And that money grows in a tax deferred manner. So it can really grow a lot faster. That's the
Now,
good
if
side.
if you
Okay.
transfer over to the self-directed, do you get penalized from a tax standpoint, or is
No,
it just like it
no.
rolls over and it never changes?
That's essentially a rollover. Okay. And by the way, should make my disclaimer. I am not a tax advisor. Okay. I'm just explaining like the general concepts as I understand them. Taxation is a complicated world, okay? And you want to seek out a good CPA, a good professional on this stuff. But
Absolutely.
what I'm giving you is the basics, okay? And you can go from there. So there should not be any tax if you do it right. You just basically roll it over to a self-directed plan, which I did years ago. And the downside of it, though, there is a sort of significant downside. Once your money is in that plan, if you want to buy a property, you can buy a property, but the financing that will be available to you will not be very desirable. Okay.
Mm.
One of the things we love about income property, especially single family homes, is they offer the best financing and the best leverage of anything out there. I like to say they're the most historically proven asset class in the entire world. They're the most tax favored asset class in America, and they're the most debt friendly asset class in America, too. So you do lose the opportunity to get those highly desirable loans on your property if it's inside the plan. Because think about it from the lender's perspective, it's a non recourse loan. Their only recourse
Okay.
is your retirement plan, right?
Mm.
So the financing available is not as good. There is financing available. Of course, you can buy properties with all cash, but that's not a very good deal. I mean, it might be better than a lot of other investments, but if you want to really do the real estate thing right, you do it outside of the plan. Okay.
Right.
The,
And,
here's one more thing I want to say about it.
okay.
A plan, a 401k or an IRA, is a tax efficient vehicle. So that's on one side. Income property is also a tax efficient vehicle. So what you're doing is you're taking one tax efficient vehicle and putting it inside another tax efficient vehicle. It's sort of not necessary in a way, because you can get great tax benefits from the income property outside of the plan. Okay. The question comes up, they've already got a bunch of money in their plan. And maybe they don't have money outside of the plan or as much to invest in properties. So you can do it in the plan. I'm just saying it's not as good as outside of the plan. Now, one of the authors that's written one of the Rich Dad books, who has been on my show many times and spoken at several of my events, he's the tax expert, okay, Tom Wheelwright. And he hates the plans. He says, like literally, if you read his book, it says, basically just dissolve your plan, pay the penalty, and invest outside the plan. He's really against it. Okay. I don't quite go that far. I might take a middle road and say, look, if you've got another 10 or 20 years to invest in that plan, I might say, if you've got money in there, stop putting more in. Okay. Just use the money you have in there, invest it as best you can, and do everything outside your plan. You lose a little bit of tax benefit, but you can get a lot of tax benefits from just buying and owning the properties anyway. Okay.
Yeah, that makes a lot of sense. Now, you brought up a couple things here that I want to circle back to. First is the tax benefit of owning an income property. And correct me if I'm wrong, but just the back of the napkin math that I've done is if you use a basic amount, let's say 50%, 60% leverage to buy an income property, pretty much if you do it right, the entire amount of the positive cash flow will be tax-free because of the depreciation on the asset. Am I seeing that right?
Sort of. Okay. This is one reason that we want the whiteboard again. So this is one reason you want to leverage your properties. Okay.
Right.
First of all, because if you start generating a bunch of positive cash flow, all you're going to have to do is pay taxes on it. Okay. When you leverage the properties and have low cash flow, I know it sounds counterintuitive. Okay. It really does sound counterintuitive. But Jason, don't you want to have positive cash flow? Not really. Okay. What I want to do is employ a strategy that I teach. And this, in and of itself, takes a half hour to explain. So you can just go to my podcast on whatever podcast platform you use, just type Jason Hartman, find the Creating Wealth Show, and look for the episodes on what I call refi till you die.
Right. Yep.
Refi till you die. This, George, is the most tax efficient way to extract the wealth from your properties. In a nutshell, basically what you're doing is you're allowing your properties to appreciate over time. You're generating some positive cash flow, but once they get to a certain point, you want to refinance those properties, take the equity out, and spend that money on your lifestyle. Why? Because there's no tax on borrowed money. When you borrow the money out of your properties, there's no taxable event. You get that money is tax free. It's beautiful. Okay. Whereas if you allow the properties to appreciate and you increase rents, your cash flow is going to get higher, and so is your equity in the properties. And neither of those things are ideal, believe it or not. I know to some people, they're thinking, oh, that's just not the plan I was taught. Okay. The rules changed in 1971. A lot of people are still operating out of a playbook that their parents or their grandparents told them, which made sense at that time. And even though 1971 was a long, long time ago, it took many years for the change in rules to play out in in society. And of course, I'm referring to coming off the gold standard when
Sure.
Nixon did that. And that's what changed everything. That was a groundswell. Let's talk about the best tax benefit in America, okay, bar none.
I'm
And
ready. I'm ready, buddy.
yeah, okay, here it is. It's depreciation,
Yeah.
okay? Why is depreciation so great? Because it's a non cash write off, it's a phantom write off. In other words, most tax benefits, if you want to get a tax benefit, you got to write a check. You got to spend some money. Okay.
Mm.
So let's dive into this and see how this works. Good old whiteboard here. Okay.
There you go.
Um,
Love it.
when you buy a property, understand that you're not buying one thing. You're buying two things. You're buying land. Okay, that's one component is land. Okay, so land, and then you're buying the house or the apartment building sitting on that land. That's the improvement. Okay, and why is it important to separate the property in quotes into its two component parts? Because the IRS separates it, and also your lender separates it, the tax assessor separates it, and your insurance company separates it. So we should also, as investors, look at it as the property and the improvement. Okay. Why is this important? Because the land, the property, if you will never go away. It can't burn down. Okay. But the house could burn down. And if it doesn't burn down, the house will depreciate in value. Houses get old, okay? They will eventually fall to the ground and be of no further economic value. Now, because we have this terrible system in America, the lobbying system, I guess it was a good idea at the start, but it's all become, you know, totally corrupt, okay, with hand, money and brown paper bags to politicians, right?
Sure.
The IRS has this schedule for depreciation, and they basically say this house will be of no economic value in a certain number of years.
Mhm.
Because of the wonders of lobbyists, they pick this odd number, 27.5 years. Okay. Now, how long does a house last? Well, I don't know. What do you think? 50 years, 100 years, 75 years, 500 years? Certainly there are houses that are 1,000 years old. Okay. I remember about 20 years ago, I was in Paris with my girlfriend at the time. George, we stayed in a hotel that was the oldest hotel in Paris, and it was like 930 years old at the time.
Wow.
It
Very
wasn't
cool.
very
So
nice,
cool.
but it was interesting. It looked like Dracula's castle, but not even that nice. Anyway, so the house will fall to the ground and be of no economic value. So the IRS says, look, the land cannot be depreciated. It will still be there. The
Mhm.
house will not be there. So if we divide these two component parts up into their component values, let's take an example. Say the overall price of these two items is $100,000. Okay. And say that we attribute the value to the land of $20,000, 20K. That means the value of the house is $80,000, 80K. Okay. So let's take our calculator out. So I've got my phone here and it's got a calculator app on it. And what am I going to do? I'm going to take the improvement, the house sitting on the land, $80,000, and I'm going to divide by the number of years I'm allowed to depreciate that, 27.5. So 80,000 divided by 27.5 equals $2,909 per year. That's the amount of depreciation write-off if I qualify. And that's a complicated topic that we don't have time for. Okay, but if you qualify for this depreciation, and there are some ways you can actually make yourself qualify potentially, especially if you're married. Okay, you might say being married costs a lot of money. but it has some tax benefits. Okay, so so for much more information on this, go to jasonhartman.com. In the search bar, type in real estate professional, and that is a IRS tax status that you may be able to qualify for, that will allow you to take unlimited depreciation deductions. It's a beautiful thing. That is a
Yeah.
gift from the IRS. It's big.